As the stock market is currently down over 6.5%, tomorrow's jobs report could not be more important. I mean, this could really shape the next couple of weeks for markets, and for better or for worse, it's really going to drive the next narrative. Here in this video, I have a warning for you about tomorrow's jobs report, why I think it's going to be potentially even negative. But first, take a listen to what these Fed officials said today. Fed Bostic coming out just minutes ago with some very weird comments, like even Fed Bostic, which is one of the more hawkish members on the Fed, worried about inflation. He's coming out and saying, yeah, we could have a problem on our hands, essentially reading through the lines. And then Fed Waller earlier today also said some things that really make you wonder about the economy. Fed Bostic says the economy is in remarkable flux, difficult to know where things will land. He says that if you wait for trends to show up in national economic data before acting, we could be too late. That sounds scary. Bostic calls for vigilance over any changes affecting prices and employment. Bostic explains that tariffs bring elevated costs, which will translate to higher prices. He says whether higher prices translate to higher inflation is a question. Fed Bostic says this year my outlook at the start of the year was inflation would be bumpy, and that's what we've seen. Bostic says the direction is still very much uncertain. He says that businesses are optimistic about some parts of the economy, like deregulation and energy, but that's not really like the most bullish thing that could be said. If only energy is like, people are bullish on energy. That's not great. Bostic says that he does not anticipate we'll have a clear answer for some time. And he also says the economy's future is uncertain. He also says, I would be surprised if we got a lot of clarity on impacts of policies before late spring into summer. So really throwing doubt on you know, they're not going to have clarity on what policies will do to inflation and even the economy. And look at that. As these comments are coming out from Bostic, TLT is skyrocketing here in after hours, up almost 0.5%. And the SPY is actually falling here in after hours. That is a direct inverse correlation. Fed Bostic says there will likely be a decision about Fed rate cuts at the May meeting or at the June meeting, but will depend on how clear things get. And he says that it's unwise for the Federal Reserve to shift strategies between meetings. And here's what Fed Waller said earlier today. Now, Canada's finance minister says Canada will delay second wave of tariffs on 125 billion of US products until April 2nd. So, you know, I guess that's good, but it really doesn't change the fact that tariffs are coming. Fed Waller says not all tariffs are passed through. He says that Fed policy is still restrictive, and he says the Fed can cut rates for positive or negative reasons, which I know that's going to sound confusing, but like a positive reason would be inflation coming down, negative reason would be like the economy going in the poop chute. Fed Waller says he is seeing some signs of softer data. And look at this, Fed Waller says we have to respond to hard data, which hard data would be CPI reports, would be non-farm payroll reports, unemployment rates, things like that. And tomorrow, again, is the first real set of hard data that we will get on the economy since the growth scare started. I guess retail sales, personal spending was also hard data, but not enough for the Fed to get too dramatic about. Fed Waller says, I'm waiting to see if weakness in soft data shows up in broader statistics. Fed Waller said today, I don't see a case for a March rate cut. But he says, I could see rate cuts after the March Fed meeting. Now, why he's saying this is because he doesn't want to spook markets, okay? If he comes out and says, yeah, guys, it's March 6th, and I could see the Fed cutting rates in March, like 2 weeks from now, markets are not exactly going to love that. right? That would be the definition of the Fed cutting for the wrong reason. The odds of a March 19th cut right now are at 10%. The Fed's going to do whatever's priced in by the markets. They always do. Okay, he said this today because there's a 44% chance of a Fed rate cut May 7th. Okay, you're almost pricing in the Fed to cut rates May 7th, but you are not even close to pricing in the Fed cutting rates March 19th. But if the data does come in really soft tomorrow, that could definitely sway the odds towards a cut March 19th. Ed Waller says, if February data comes in good, I will feel better about inflation. He also says a median of 2 cuts this year remains reasonable. And Canada says they will not react to Trump's latest move on tariffs until officials have studied the executive order. Fed Waller says 80 to 100,000 is likely break even for the jobs market. Fed Waller says job market conditions more closely resemble pre-pandemic times. Now, for tomorrow morning's data, we will get non-farm payrolls, the unemployment rate, all of your secondary data that goes alongside those. We will get speeches from Fed Bowman at 10:15 in the morning, Eastern Standard Time. Fed Williams speaks at 10:45 a.m. Fed Kugler speaks at 12:20 p.m. around noon. And then Fed Jerome Powell speaks at 12:30. So you will get 4 Fed speakers right after we get the non-farm payrolls and the new unemployment rate. Now, why tomorrow is so critical for markets is it's actually pretty simple. Recently, we've gotten this growth scare. Bad retail sales, bad personal spending, really bad real estate data. I mean, you could kind of go on and on there. But we haven't gotten too much hard data, like non-farm payrolls. We actually haven't gotten a single non-farm payrolls report since the growth scare started. So that's why it's so important tomorrow. And I'm not super excited about what that number could look like. First and foremost, when you look at the Challenger job cuts, this is like very much recessionary numbers here, okay? We came in today at 172,000. We were expecting 56,000. This is like the highs of 08, 09, right? This is like the highs of the dot-com bubble kind of, Challenger job cut numbers. You do not see numbers like this during a normal economy, okay? That's very bad. Very, very, very bad. So, I think Wall Street expecting 160,000 job ads when last month was even 143,000 is misplaced. I think that estimate is going to be far off of the actual number that we do get. Take a listen to this. This is the summary for the Challenger job cuts number today. Now it says U.S. employers announced 172,000 job cuts in February of 2025, the highest value since July of 2020, compared to about 50,000 in January. It is also the highest total for the month of February since 2009. With the impact of the Department of Government Efficiency actions, as well as canceled government contracts, fears of trade wars, and bankruptcies, the job cuts soared in February. It says the government led all sectors in job cuts in February at about 62,000, followed by retail at 38,000, and tech at 14,000 so far this year. It says employers have announced 221,000 job cuts, the highest year-to-date total since 2009. A lot of references to 2009 there. And what I actually think is going to be interesting is the non-farm payrolls, the estimates are for negative 20,000 government payrolls. So for about 20,000 people to on net lose their jobs from the government. That number could be higher because we should get reflected the government buyouts. Okay, the whole Doge buyout thing should be reflected in the February quarter. I don't think 20,000 is a very accurate number there. And that's where I do have a little bit of concern. Now, the big concern that I have is on tariffs and really the volatility in Washington. We can handle bad news. Like, that's fine. If you give business leaders bad news, whatever. Like, we'll figure a way around it. We'll figure out how to deal with it. but there's uncertainty. The last thing businesses want to do when there is uncertainty is hire people. That's like the one thing you don't do when you don't know what the tax rate's going to look like, when you don't know what tariffs are going to look like, or what companies you're going to have to do business with, or how your company is going to be affected by those potential tariffs. Okay? Like, it's the last thing you do is hire people when there's this much uncertainty. And that's a problem. So I actually think if there was a jobs report that could come in negative, it could actually be tomorrow morning. Now, what I also find concerning from an equity standpoint is, yes, you have fallen 7% from all-time highs. You're currently down about 6.5% from all-time highs. But you really haven't priced in that recession risk yet. And if the jobs report is really bad tomorrow, even if it's not negative, but just bad, people are going to start questioning whether or not we could be heading into a recession soon. And that, well, could cause a lot more downside in markets. Vice versa, though, you are down a lot from all-time highs. This is the fastest sell-off I believe we've seen since the .com crash, if I'm remembering the statistic correctly. This is a very fast sell-off that we have seen so far, and markets want to bounce. You're sitting right at about that 200-day moving average. So if the jobs report doesn't come in too bad, well, you could bounce, right? And I think tomorrow is going to be extremely volatile and really data dependent. Now, the big risk that I could see tomorrow is actually a change in expectations, okay? What you're looking at here is a bell curve, okay? But what I want to highlight is tail risk events. Now, a tail risk event is something that is simply out of consensus, okay? And it could be really out of consensus. Like, in the worst case scenario, you have a depression here. That, yeah, I'm not Da Vinci. I not the most talented artist in the world, but I think this serves the job well. You have a depression here, like 1929. Like, that is a very negative tail risk event. Nobody expects that to happen, but big potential, impacts could come from that, obviously, in the stock market. What are the odds of that? Probably very, very low. What are the odds of a recession? You have this on the bell curve, and what's higher up here is more likely. So right in the middle would be like the average market participants' expectations, like 2% GDP. We get close to about 2% inflation by the end of this year. Earnings come in at about 10-12%. But what really moves markets is these tail risk events, and they can be positive or they can be negative. And what I see tomorrow is, if the jobs report is bad like I think, the average expectation could shift. This bell curve itself could shift towards like 1% GDP as being what people think is, now the average or most likely. As you slip closer to recession, that's where you get more and more downside in markets. Think back to 2022 when you had, 100% odds of a recession. Almost everyone thought we were heading into a recession. S&P was down 27%. Tomorrow's jobs report could give a big jump to the bell curve, right? In the negative direction if that jobs report comes in bad, okay? And again, it's the first real hard data on the labor market we have gotten since the growth scare has started. And, what I think to myself and what I'm trying to figure out right now is, over the past like 40, 50 years, we've only really ever went into recessions when you've had catalyst, right? When you've had something bad happen. Could Doge, the government, cutting back spending, firing people, the trade war, really reducing confidence out there? People don't really want to hire. They don't want to spend as much. I mean, if you don't know if you're going to have a job next week, you're not going to go out and spend a bunch of money. Could all of these things together be a catalyst to give us a recession? Maybe. I don't know that answer. So right now, Wall Street's pricing in a very little chance of a recession. Probably 5-10% chance of a recession is what's priced into the S&P right now. If that jobs report is bad tomorrow, you have to start pricing in more of a chance of a recession. Like, if we come in at negative 20,000 payrolls tomorrow, there's going to be a lot of people that are talking about a recession, and the odds will jump of that. Okay, now on the positive end of the bell curve here, the positive tail risk event could be 2% GDP, 2.5% GDP, inflation coming down to 2% this year. In the very extreme side of that, it could be 4% GDP, 20% EPS growth, a lot of Fed cuts, real estate that starts booming again, and inflation between 1.5% and 2% by the end of this year. That's like the best case scenario. The problem is, I think at average expectations right now, you're pricing in a very optimistic situation for this year, given what we have going on in the economy right now. Now, what I think is also concerning is a lot of the momentum stocks that have rolled over recently. Tesla down 40+%, Palantir down about 40%, and really there's a lot of others. It kind of reminds me of the start of the rollover in 2021, 2022, where this is the MTUM, this is the momentum ETF. It peaked out, hit its all-time high November 8th, 2021, but the S&P actually didn't peak out in 2021 until about December 31st, the first week in 2022. So the momentum stocks peaked out about 2 months before the markets peaked and started rolling over, right? With momentum stocks, by the time the S&P actually peaked, this momentum ETF was down about 12%. And other stocks were down 30, 40+% in that momentum space by the time markets hit a new all-time high. So it's always those momentum stocks that go first when you're entering into what could be a prolonged market downturn. I also find it concerning that, like, the VIX today opened at 2260. It closed at 2487. Like, yeah, the VIX is high, but you haven't gotten that panic moment yet. Like on December 18th. On December 17th, the VIX was 1498. The next day later, you hit 2762. Within 24 hours, the VIX almost doubled. You have not seen that yet. And typically when corrections come to an end, you normally get this big, VIX spike. You normally get the big wave of panic that comes over, and that simply has not happened yet. If the jobs report is bad tomorrow, that could happen. You can also see the Russell is down a lot from all-time highs. Really the most, recession or slow growth sensitive index. You're down almost 16% from all-time highs. And again, the S&P is not reflecting recession risk, but the Russell, momentum areas, they are. And, could that creep into the broader markets? Possibly. So again, I don't know exactly what's going to happen coming tomorrow morning. I have a feeling it's going to be a bad jobs report. I think markets probably move lower on that. But, we have fallen quickly. It wouldn't surprise me to get an aggressive bounce tomorrow. I don't think this is like a August 5th moment where we just go roaring back to new all-time highs. I think you could bounce a bit, and then you're going to come back down, right? You're going to bounce a bit, come back down. And I'm really expecting the sideways trading action for the foreseeable future with a downside bias until the uncertainty around the economy, the Fed, inflation, and just Washington in general really gets, some clarity. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.